Hey, thanks for tuning in. In this video, we're going to review how to identify trends and how I use this data in my everyday market analysis. So the first thing we'll do is discuss what the trend is. What's the textbook definition of a trend. Then I'll go through, how can we look at what the concept of trending and then not trending or range trading. We'll look at price action, high lows, and how we can use that data to conclude definitively what the trend is. We'll look at the moving averages, which are lagging indicators, right? They just look at the past, X days of data and draws these, lines over time. So it's a simple way to look at the trend. We use them all the time. I'm going to look at the time frame, multi-time frame analysis, quarterly, monthly, weekly charts, all the way down to hourly charts. And then from each, larger time frame, we talk about the concepts of like a short-term trend, a medium trend, and a longer-term trend for each of the charts. And remember, all charts act and react at the same. That's the fractal nature that's always mentioned in technical analysis. We'll look at some trend lines and how you can draw them to help identify the trend. We'll talk about breakouts and how they impact the trend. And then just we'll conclude with the idea of whether or not trends have destinations, or does the market have a destination. So the trend is really defined as a direction in price, either a rise or fall, that can be profited from using a trend following system. That's the textbook definition. So what we're looking for is like a series of higher lows and higher highs, and you're just looking for that to continue over time, for whatever reason, right? Things tend to trend. When the market is not trending, it's in a larger range, and that's where the market sits most of the time. Most of the time, the market's range bound, and then for another period of time, 30-40%, it's trending. And then when it's range bound, it's pretty obvious. I put these all over all my charts. These big old rectangles. That's a non-trending market, right? Price just goes sideways. We use the moving averages. The slope of the moving averages is key, right? So if the slope is up and price is above, trend is up. If slope is sideways, there's really no trend. If slope is down, price is below, trend is down. But when you look at the moving averages, you also have the posture of the moving averages. And as you can see here, right, back in August of 2019, and we're looking at a chart of NVIDIA, this is the daily chart, you can see that the posture was price was below a declining 200, which is my brown line. And right here, price started to get above the 200. Also in August, the blue line, which is my 40, crossed above the 200, and the orange and yellow and green all crossed above the 200. So in order to have a bullish posture, you need to have the shorter term time frames, right? So that's the short, medium, and long. This concept of any moving average that's under 10 is a short term moving average. Medium, in my opinion, is 20 to 40. So that's my green and blue. And then the long term are like 100 and 200, which is this blue and brown for me. So on every time frame, you'll have this concept of what's the short term, medium term, and long term trend on the daily chart. And those are different numbers and answers than for the weekly chart. And that's what you have here. This legend will tell you the moving averages that I'm using. But the posture that I'm talking about is the arrangement of those moving averages, right? And its relationship to price. So as price recaptured all the moving averages back here in October 2019, it was really the start of a new trend, right? The brown line, which was supply acting as resistance, became demand and was confirmed demand here during the COVID lows. And this bullish posture is what we use to talk about the trend. When you look at a trend line, we could have drawn something like that. But in the end, you know, when you draw your trend lines, all you're really trying to do is connect the highs and the lows, right? This high, this high, this high. And you know, what you start to do is define, you know, where price is relative to this trend line as a way to measure, again, the trend and how steep it is. And you can do the same thing up here, right? Very similar. So we have an increasing slope in the trend line, and price is above it, right? So the trend is up. So these are like the basic ways that we look at identifying the trend. You know, one other thing that we want to talk about here is this price action. I don't want to go over that. So, you know, in order to look at that, what we're going to do is take everything off, right? All the cheats, all the moving averages, and just start looking at price action. And we'll start with a downtrend, right? Because back here was an actual waterfall decline from, you know, 72 to $30. So up here, you know, coming into this point, you clearly have a series of higher lows and higher highs. We'll start from this pivot low and we'll just start counting it, right? So here's our high. Price comes in, puts in a high at 57, pulls back, puts in a higher low at 55, then breaks the 57, right? High, low, higher high. Pulls back, puts in a higher low at 60. So here's our low, and then ultimately puts in another high here. But then what happens? Breaks the pattern. So the daily higher low was lost right here. So what you would have to do is zoom out to the weekly to understand the context of the correction. But very basic, what you're doing is you're identifying the key pivots and then comparing them to before. And so if you'd zoom out to the weekly, you'd see, all right, well, this was a weekly low here, a weekly high here, a weekly low here, a higher high here, a higher low here, a higher high here on the weekly. And then this is where the weekly fell apart, and the daily, and the monthly. And we'll look at this multi-time frame analysis in a second. I just wanted to focus a little bit here on the price action component. But you can see all of that here in this move, this low to this high, the higher lows that get set, when they break, how it leads to sideways and consolidation for quite some time, because then the larger time frame is the trend that's consolidating. But how ultimately that can continue to a higher high again, and even breaking this low here, which is a zigzag and Elliott wave. Even that pattern is a buy setup, right? And you'd say, well, wait, isn't the trend down? Didn't we just confirm that the trend is down? Well, no, you've identified that you've broken the daily higher low, but you'd have to zoom out to the weekly, in this instance, one time frame higher, to see if there's a trend there that's still intact, and you'd find that there was. And then when all of this lost, you got to start building again, right? So they start the low here, high, low, high, higher low, high, higher low, keeps it rolling, breaks all these highs, comes back, sets a higher low here, broke all these higher lows that she just set, but in doing so, maintained the monthly and ultimately, in this instance, quarterly higher low, which led to an explosion in price. And really what this is everyone who got short here now had to cover. They realized the bottom was in. And with these, massive declines, these 50% declines, what ultimately happens over time is a large trading range gets carved out. And we could have looked at, before any of this happened, we could have identified, oh well, this is a gap up here, that's a gap window there, some important levels, to look at. But ultimately, you would have seen that this was the trading range that got carved out, and where price remained from November 18 to November 19 for about a year. And ultimately, where price came back, and after she broke out, it's where she tested, right? All based on that gap down, that one price level. But the point is that, you can see this in the price action. When you lose the series of higher lows and higher highs, like you did here, you have to zoom out to the weekly chart. Oh, we got zoom. Well, that's kind of strange. Sorry there. It's like it sent us all the way back to the beginning. But when you lose that higher low and higher high, you have to zoom out, right? Because here's the series of higher lows and higher highs. Let's just remove all these. Start over. There's your low, high, right? Oops. High, higher low, higher high, higher low, higher high. Broke the higher low pattern. Zoom out. All right. And so it's the same thing here. You'd say, oh, well, the monthly had this higher low pattern that was going on that you can very easily see, right? That's why those dips got bought. That's why all those bear setups got foiled. The monthly chart, which ultimately was the chart in charge here, was in the process of putting in this rising wedge ending diagonal. And when that broke, right, because you can see here this pullback, this low of 58.75, 58.32, 59.68, 64.67, as soon as that higher low pattern broke, look at all the energy that was released to the downside, right? And that's simple price action. You don't need any moving average to tell you that the trend broke, right? What was the trend? It was this series of higher lows that just kept happening here on this chart, right? You don't need the moving averages to tell you that those are lagging indicators. This is what's happening, right? This high, this low, this high, this low, this high, this low, this high, this low. It's like a pinball, and it's collecting all market participants as it rises up towards its destination. So, this is how you have to look at the multi-time frame component, is that you have to start at the monthly, the quarterly, even the yearly chart, and then zoom down into the daily and hourly price action. Because you'll see that there are trends on the monthly chart that are driving the price action that you're experiencing on a 10-minute or hourly chart. And why does every bull break get sold, or why does every bear break get bought on the daily time frame? Well, zoom out to the monthly, zoom out to the quarterly, and you'll have your answer. There's likely a very strong uptrend or downtrend that's sustaining the trend in price action that you're witnessing on the daily and hourly charts. Okay, that being said, let's turn the indicators back on, because we do like to use them, but they do distract from the price action that's taking place. We'll talk about breakouts here for a second. We'll go back to this trading range that we identified, and how when price found acceptance above this high, right? And you could even draw it down here. It doesn't really matter, right? When price got above this $48.50, what happened? She trended for a while, a very strong trend. And how would we have identified that? We'd go to the weekly, we'd look at our PPO, and we'd say, wow, look at that trend. You can see it in your indicators. So we use the PPO indicator to help monitor and judge the intensity or strength of a trend. And the strength of the trend can intensify. So all trends have the same story for the most part. At the beginning of the trend, it's very exciting. It's very new. Everyone loves it. You tend to get breakaway gaps, lots of volume, etc. Then it kind of tapers off, and then you get another explosion, a runaway gap, more interest in the trend as it intensifies. That's generally the halfway point. And then the trend ends in some climactic end, right? The all auctions end in euphoria. So is it bear euphoria or bull euphoria? Who knows? You just have to look at the trend for that answer. But they all end the same way. And we use this PPO indicator to help give us the strength of the trend, but also the moving average, EMA 5, SMA 10. If you're just riding EMA 5, SMA 10, that's as strong as it gets. The weaker trends will pull back to the 20 and the 40 more frequently. But yeah, when we talk about the short, medium, and long term and multi-time frame, multi-time frames is using 3 charts, to identify your trend, right? We're bull on the monthly, bull on the weekly, bear on the daily. That means we have a buy setup opportunity. We're bear on the monthly, bear on the weekly, but bull on the daily means we have a sell opportunity, a short opportunity. Why? Because the probability is that the trend will continue. That's it. That's all you're betting on. And what do we do generally with these trends is that we like to identify mean or some moving average that will act as a destination when the correction begins. So when the supply-demand imbalance ultimately spawns a reversal, there's generally, in my opinion, a destination that the market makers have in mind. Ultimately, that's decided by supply and demand every single day. Don't get me wrong. But more often than not, you can come to some conclusion on where these corrections will end, or where price will revert to mean is a better way to say it, because all that you're witnessing on something like the S&P 500, is price just continues to rise in an uptrend, and any dip, everyone calls for, the start of some long bear market, but in reality, it's just mean reversion every time. So, what we're looking for is what's the mean that price is going to revert back to in this particular point in time. And that's what I talk about. Do trends have destinations? Not is the price going to rise to some level and then stop, but more or less when a correction starts, right? When we go from trending to no longer trending. This point here, this point here, this point here. When we do that, does the market have a destination in mind? And I think the answer is yes. And a lot of the time that's driven by mean reversion. But yeah, that's pretty much what I had to discuss in this video. Just how to identify the trend, right? It's not a simple answer. There's a lot of ways to do it. Just try to keep in mind that there's a short-term, a medium-term, and long-term trend on every single time frame. And that if you're going to talk about multi-time frame analysis and trend analysis of, what's the longer-term trend? Well, what, on the daily or on the quarterly, on the yearly chart? What chart are we talking about? We're talking about the S&P 500? We're talking about something that has 100 years of price history? We're talking about something that's 5 years old? We're talking about an IPO from last year? All you'll have is the daily chart. So it's all relative to the security that you're talking about. So yeah, that concludes the video. If you like it, hit the like button, subscribe, so you get notified when we put out new content, and we'll see you in the next one.